How's it going, everyone? Welcome back to the channel. My name is Brian, and in today's video I'm going to be showing you guys how to trade options on Webull. The reason for this video is because a lot of people are transferring over from Robinhood to Webull, so and obviously a lot of you guys are options traders now, or aspiring options traders hoping to make a killing, right? Options give you leverage, great way to make returns. If you're gonna day trade, day trading options is the way to go. Trading stock, unless they're penny stocks, you know, high percentages in a day or two, that's where I would trade stock. But overall, I usually trade options, and especially options on large cap names like Apple, Amazon, Netflix. I used to trade Tesla. I made a video about that. Didn't go so well, but that was hilarious. Losses weren't hilarious, actually. So how do we day trade? How do we trade options on Webull? So with Webull, you have the little options button at the bottom, which I'm going to show on screen. There, I tapped it. This is why I'm making this video, to explain. I'm not going to go over options, like what are they. I suppose you already know. A call is when you're betting the stock will go up. A put is when you're betting the stock will go down. And then there you can go on from there. Selling options, covered options, naked options, straddles, collars, all of that sort. Call debit spreads, a bull spread, a bear spread, a bear spread, a bull spread. There's so many lingo and jargon out there that I'm not gonna go over it, but if you can identify what strategy you wanna do with options, then all you have to do is come on over to the options tab on Webull on whatever stock you're looking at. In this case, we are on Apple. And let me just give you a little bit of guidelines on what you're looking at, all right? It's gonna open it up to a whole bunch of strike prices already, but I'm gonna close that up, and we get a chain of options. These options range from February 19th all the way to March 17th, 2023. So we have a variety of timelines of these contracts that we can start choosing. So from here is step one. How far or how soon, how much time do you want on your contract? Are you trying to day trade this and just the nearest expiration contract? That way it's the cheapest and the most volatile. So if it moves up, if it moves in your favor, you know, profits are made. If it moves away from your favor, losses stack up pretty fast also. So you gotta be careful. If I'm day trading, day trading, like, you know, within a couple of minutes, I will go for the soonest expiring. So that would be, in this case, February 19th, or in 4 days. If I'm gonna swing an option, I usually like to go out 3 to 6 weeks depending on the prices. For this example, 1 month contract for 32 days that expires March 19th. Now I have to, you know, scroll towards where the stock is trading at, which I believe it's 135 right there. And then 140 strike Apple call is trading around $300 for 1 month out. Not bad. You see, again, that's why once you're doing options trading, you gotta understand the Greeks. The Greeks are gamma, vega, theta, delta, and IV, which is vega. Again, this video is not to comprise of what are they, it's to show you guys, okay, how do I trade? But that's the cool thing about this. Like, you get so much information. You get all the Greeks right here. On Robinhood, I believe you have to tap on the bid-ask spread and then it shows you the Greeks. But that's where people go wrong, because sometimes a simple solution to like choosing good contracts is by knowing how much open interest there is. And open interest is defined by how many contracts are out there in circulation. Right here, well, funny enough, it's not here, but the next best thing is volume, and volume is how many contracts have been traded within the day. And then the ones with large volume, you can see they're pretty liquid, which liquid translating into you can get in and out pretty easily. The bid and the ask spread are pretty tight, so you won't lose money to like having to buy at the higher ask and sell right away at the lower bid, and that can cause you losses of money in an instant. From the moment you purchase a contract, you can be in the red. Luckily with Apple, a huge liquid stock as it is, and then its options contracts are liquid as it is. But if you are going into a stock, like let's say one stock that is pretty okay is Fiverr stock. That one has a pretty wide bid-ask spread, and the best contract with the best strike price is going to be determined, in my opinion, by the volume of how many of that strike the contracts get traded, because you can once again get in and out. So that's very important, and I do like that it's here just right there at a quick glance. Overlooked, but it shouldn't, especially again with not so liquid stocks that you still want to take a call position. This example being Fiverr. Another stock that I like to trade is Lowe's. You know, everybody knows Lowe's. It's a huge high cap stock, but at the same time, like, is it liquid? You can determine that by looking at the volume of the options contract that you're looking to trade. Well, moving on, we are on the calls right now, but if you want to buy a put, you're thinking Apple's going to go down. You looked at your chart. Apple looks like it's losing momentum and sellers are stepping in. So I actually want to buy a put. So now you just tap on the puts, or if you want to be looking at them simultaneously, both together, you just put on both. I usually just concentrate on what I want to do. So usually it's calls right now. We're in the best bull market right now. So calls has been the way to go. I'm a daredevil. I have bought and puts in this bull market. I lose money, but that's besides the case, right? But yeah, okay, so I chose what day I want my options contract for. I chose March 19th. When you tap on it, like I said, you have to kind of scroll where the price is trading at. Unfortunately, that's the thing with the mobile. It shows you everything, so just quickly scroll towards it. So 135 right here. We're looking at the call, and you know, I want a fairly cheap contract with some good upside. Apple's trading at 135. I think it can go to 145 within a month, but I don't want to pay 170. I want to pay less, so I'm going to choose the 150 strike, and I'm picking the $100 contract. That's just for whatever reason in this example that I'm choosing it. You tap on it, you get the criteria at the bottom. You get the strike, the date, what it is. It's a call, you're buying, and how many, the quantity right there. I'm tapping, okay, I want 5 contracts, so this should cost me about $500. Oh, hold up, I actually want to sell. Like, I'm gonna sell call options. You can do that by clicking on sell, but we're gonna buy. And then to confirm the trade, then you go to edit. And then on edit, it gives you all the information of just that contract specification, the 150 strike for March 19th. Again, a lot of information at the top. It gives you a little graph of how much you can lose. You can lose a maximum of $100, and the max you can make, it shows you right here with delta on the little graph, you know, exponentially, quote unquote, infinite. If Apple runs over 150 to 160 to 200, like, your call option will be far in the money and you'll be making bank. Less than likely for that to occur, but nonetheless, a nice little graph at the top. Scrolling down, again, just all the criteria and the information right there. It's a long call, you're buying it. Again, it's a call, the strike, the date, and then order type is very important when making your order. Okay, limit, I'm willing to pay this, maximum, which limit basically means maximum of what you're willing to pay. Unless you do a market will buy it to you at instant. Usually market will buy it to you, your option contract, for the ask price that's currently trading. I don't like to do market anymore because you get slippage. Slippage is a term where you're probably going to overpay. Like, let's say it's trading at 1.0, the ask is at 102. There could be that that they'll give it to you for 103 or 105, and you're overpaying because you chose market for slippage. So I usually like to do limit, and if I really want it, again, right now, these contracts are pretty tight. The bid and the ask are basically, you know, like getting filled on the spot. So I would just make sure limit 102, bam, bam. How many contracts? Make sure you're looking at how many contracts you have. That's happened to me. I overbuy or I underbuy because, like, you know, it's just so easy to overlook on your small. Like, I have the iPhone 12 Plus, and it's a big phone, but overall, like, you're looking at so many numbers on the screen, and especially when you're making tough decisions on the spot, in a quick glance, like, you can quickly overlook little things, and that also causes you to lose money in trading. Unfortunately, it happens to me, happens to the best of us, and if it hasn't happened to you, it's gonna happen, unfortunately. Like, that's just part of the trader's journey. You know, there's mistakes like that where you buy way more contracts than you were anticipating by accident. Like, oh gosh, I thought I was, you know, putting in my limit. I wanted to pay 100. That's why I put 1. Or my limit, you know, a mistake like that. Time enforced, again, a day or good to cancel, which is for 90 days. I usually like make sure it's good for the day. And at the bottom, estimated premium is like the estimated cost that it's going to cost you in your account, and that is called a debit. If you're selling a contract, if you're selling a call, if you're selling a put, if you're selling a covered call, colored, you know, if you're selling advanced strategies also, that is called a credit. And with a credit, you receive the money. So it's gonna be green, like, oh no, I'm selling this. Bam, I tapped on sell I tapped on buy and it converted it to a sell. So now I'm selling this contract. I'm selling 4 of them, and so I'm gonna receive $408. That's a credit, but that is not the strategy that I'm trying to do, right? I'm trying to buy a call. So then that, and then finally you just literally press buy. I'm buying 4 call options on Apple for the mid price of 102. I'm tapping buy. It gives you a final confirmation screen on your phone. Make sure go over it. I know sometimes you're in the rush to like, no, I gotta get in right now. Apple's moving, it wants to take off. But you know, take 10 seconds, take 15 seconds, read everything. What are you doing? I'm buying this, what strike, what date, how many contracts, order type, limit. It's standard on limit price, how much you're willing to pay. Sometimes this has happened to me where my limit price for by accident has been like right here it's 102 and that's where it's trading at, but I have had the instance where it's 202 and on a different stock, but for this example I've had it at 202 and I paid way over because my limit price was wrong by the first number, which is in the hundreds, which I had instead of a 102 I had a 202, which made me pay a way higher price for a contract. That this just happened to me last week, but again, it's something that got overlooked, and just giving you guys some helpful tips. Hopefully I get, again, nonsense of like, what, you really overlooked that? Yes, it happens. Time enforced day, and remember it's a debit because I'm buying. Once I sell, I'm gonna get credited into my account, so that's when you sell your calls. And that's when you do sell a call because you actually own a call. Right now, if I sell a call and I don't own it, I'm writing it. Sorry for the confusion, but nonetheless, there you go. That's how you buy a call, buy a put. Same transaction for a put. I'm gonna tap on put. No, I want a 130 put on Apple. I think Apple's gonna go down within the next month. Okay, oh, here's a cool thing on Webull. I hope you may, if you're watching it till this far, you know, OG right there, I'm gonna give you a nice tip right here. This has helped me out super much. I love this on Webull. Okay, well, what I want to see, like, how has this contract been moving? You know, sometimes you want to study contracts also of their flow, maybe even plan out an exit strategy. So what I like to do is I'm tapping on 130 put, but I'm actually gonna double tap on it and it takes me to this page. On this page, I get a whole bunch of information on this contract, on the history, how it has been moving. Right now I'm on the 1 minute, but I'm gonna tap into the dailies. Wow, this contract, the 130 March 19th put, at one point was worth $2,800 at its highest. Why has it been declining? Number one, theta, you know, time decay, like the contract is losing value. So I probably wouldn't be, that isn't so useful, especially because that's all the way in October of last year in 2020, but like obviously that's why it's declined so much. But I will actually look at it within the nearest term, within the last month, to kind of look at where I would want to sell. If I'm buying this put and it's currently trading at 266, I will look at the date, right? Okay, on February 1st, it was actually trading around a low high of $500. I'm actually going to go into Apple stock chart and kind of compare where that stock was trading at, what price on the stock I can be looking at to kind of get that return on this contract, almost a 100% return. So, you know, just looking at the history, looking at the flow, looking at the interest, the volume. You can even use indicators. That's hilarious, right? On this stock chart, on this options contract chart. That's really nice. And volume, how much has this been trading? And the Greeks are right here at the bottom. With the Greeks, some people like to use them strategically to, you know, find a flaw in, like, okay, it's far out of the money, so the delta is low. So once we start getting closer and closer, the delta is going to increase, so my profit can increase. Stuff like that. Again, sorry if it sounds advanced. Like, there is so much to options contracts that, like, once you start understanding it, it is like secondhand nature. For me, I've been trading for like a year now, and it's been great. It's been awesome. I love trading options. It's super fun. It keeps my brain stimulated. It keeps me in the game. I love gambling. I mean, investing / trading. So I really like this chart. Again, I use it depending on what strategy I want to do, or, you know, get a feel of how the stock of the option contract has been trading. You can do that, and with any strike particularly, you can get that information by double tapping on Webull. Very nice, very cool. Or I tend to use it mainly for the 1 minute, again, to compare, like, okay, if the stock was at this price, I can assume I can get a nice return around here. That's where I'll sell and collect my profit. On the last trading day, in the recent history, this contract was at around a high of 700, but currently it's trading at 600. If Apple can start dipping, it can go back up to that value because it's a put to $700, and maybe I would sell then, or continue to monitor the stock and see if there's weakness to it, that it can fall more. So I want to take a profit around $1,000. You know, keep that in mind. Remember, trading is all about planning your entry and planning your exit, and this is just a little nice extra that I'm trying to include, that for you guys to kind of do more, you know, research. But then going above calls and puts on Webull, the call debit spreads, the put debit spread, those are called vertical spreads. So that one is vertical. On Webull, they are pre-made, and the price is already trading at that spread price. Okay, what do I mean by that? Okay, let me clear up everything. So now I have it on vertical. Okay, so I'm gonna do a call debit spread. I'm not gonna put up the full amount of money. This is usually better with stocks like Tesla, Amazon, that contracts would cost $1,000, $2,000, $3,000, $4,000. With call debit spreads, you know, you can be in the trade for far less money, and, you know, minimize your risk. So with Apple, I don't think it's the best example. So yeah, let's actually go on to Amazon, so I can show you guys the spreads and how they are trading on Webull with options. So right here, again, I'm still on vertical spreads. Always make sure you're on the right strategy. It does tend to stay with the last one tapped. So since we had it on vertical on Apple, and we're now on Amazon, it is on vertical on Amazon. Again, side note, but it's very important. Like, these nitty-gritty details do get, like, they are important to execute properly. Like, a mistake can cost you. So that's why I keep reiterating it. Next, on Amazon, where the stock is currently at $32.77, but I actually, you know, I'm betting on the long side of Amazon. So I'm gonna do the $32.80 to $32.85, which is the next one, the next price targets that it could go up to. Okay, so right here at the bottom here, now it's giving me all the details right here. So the top one is basically the sum of the both bottom ones. You're buying the $32.80 and you're selling the $32.85. This is a called debit spread, right? Debit because you're paying for the rights of these contracts. So you're buying one, you're selling one. So it's called debit spread. We go to edit, and then we'll get all the information. And again, remember, the bid and the ask is going to fluctuate, because now you're dealing with two contracts, where in order for this option to get executed with the spread, it kind of has to go simultaneously in the same transaction. But that's how you do it. As it is, remember, call debit spreads. Amazon, liquid, but not so liquid. As you can see, the bid is $5, the ask is $430. The middle, it's looking around $2.18. So be careful, again, with these with these options, with any options in general. Be careful. So that's a vertical spread. If you want to do a straddle, iron condor right here, and it gives you all the strikes on the left, and it gives you the pre-made price, bid and ask on the right, Unlike Robinhood, where you have to manually click, and you can actually go longer. You can buy with this strike and sell one way higher. I believe you can here, but it doesn't really want you to. It wants to keep it simple. I think you would quote unquote manually have to do it. So you would have to go in individually and buy one call. And then if you want a higher strike for more potential profit, you have to do it again manually, where you go into the regular option strategy, and then you go and sell a put above it, because remember, you're creating a call debit spread. So that's how you would do it if you want like more cushion, like more space between your strikes. You would have to do it manually, quote unquote automatically. With the given strikes, it's right here, pre-made. You can go above that, 32.90 to 32.95 as an example. And the same thing for puts. Put debit spread, you just tap on puts and they're pre-made right there. There you go. That's how you do it. Trading options on desktop. Let me know if you want to see that video, and if not, I thought mobile was more important because everyone's on their phone anyway. I trade off my desktop. I don't really like going into, to me this is a little bit more time consuming. I will say that it's a little bit more time consuming having to go in, and by the time, especially as a day trader, momentum trader, like I want to get in and out pretty quickly. I don't have the time to go and verify everything. That's why I trade off the computer. But nonetheless, for everyone else who is trading off their phone, that's how you do it. If you have any questions, leave them down in the description. Leave them down below in the comment section. If you like this video, leave a like. If you want to see more videos from me, you know, subscribe to the channel. I'm very invested into personal finance, business, entrepreneurship. Trading is right now pretty hot, and it's been my thing, so I just want to share what I've learned and go on from there. So yeah, hope you guys have a great day. See you guys in the next video. Peace out. Thank you. Bye.